In June of 2016, the FASB issued an accounting standard update on current expected credit losses. Prior to this update, companies only reported credit losses when it was probable a loss had been incurred. This incurred loss method became a real problem during the 2008 financial crisis. Banks weren't recognizing losses fast enough, as GAAP wouldn't allow them to consider future developments. Thus, in spite of a bleak economic outlook, loan loss reserves were not being adjusted to account for future expected losses. Under the new method, companies must incorporate information from forward-looking forecasts to estimate future credit losses over the entire contractual life of the asset. In short, banks and other companies must now forecast future economic conditions and record expected credit losses accordingly. We are therefore shifting from an incurred loss model to an expected loss model, and this is intended to accelerate the recognition of impairments. Now, the new rule for current expected credit losses doesn't just apply to banks. It applies to any company holding trade receivables, lease receivables from a sales type or direct financing lease, reinsurance receivables, receivables related to repurchase agreements, loans held for investment, held to maturity debt securities carried at amortized cost, and some off-balance sheet exposures like loan commitments and financial guarantees. Now, the rules do not apply to loans held for sale, trading assets, any financial asset for which the company has elected the fair value option, and loans or receivables between entities that are under common control. So let's talk about the journal entry that a company would record. If a company expects to have a future credit loss, it should record credit loss expense and record a corresponding credit loss allowance. The allowance account is a contra asset, so you don't reduce the asset account directly. Now, if circumstances later change and the company doesn't believe it will experience a credit loss, the company can just reverse the entry. In any case, the balance sheet should show the net amount that the company expects to collect from the financial asset. In rare cases, recognizing zero credit losses might be appropriate. So how should a company measure the allowance? Well, the FASB did not mandate a specific method. Companies could use discounted cash flow methods, probability of default methods, roll rate methods, loss rate methods, or an aging schedule. It's up to each company to develop its own estimation model. Now, if a company has financial assets with similar risk characteristics, asset type, geography, credit ratings, it can pool those assets and evaluate them collectively. And if a company ultimately finds that a financial asset is uncollectible, it should write the account off by debiting the allowance account and crediting the financial asset account. Now, if you're wondering about the international accounting rules, the IASB adopted a similar credit loss model in 2014. Thus, companies outside the US also need to estimate their future expected credit losses. However, there are differences between the international accounting rules and the US rules, so make sure to refer to IFRS 9 if your company follows IFRS.